What's up everyone, it's Karthik with MoneyVest, and in this video we are going to be talking about the market's expectations for next week when it comes to the FOMC meeting, and we're getting awfully close to a coin flip at this point, and it's crazy how the meeting is in 4 days and the market still does not know whether the Federal Reserve is going to do a 25 or a 50 basis point rate cut. Now, I'm not particularly interested in a 50 basis point rate cut because that does signal that there is economic weakness brewing underneath, and that could actually send the wrong message for the markets and for the economy as well. So I'm kind of against a 50 basis point rate cut, and I'll go over exactly why that is, because in the past, when the Federal Reserve has cut interest rates by 50 basis points, it has been most certainly due to economic weakness, uncertainty, and a lot of pain and suffering that has followed in the economy and the markets as well. I'll go over that because there's a couple instances from back in 2000s and 2007s when the Federal Reserve embarked on this rate cutting cycle, and it essentially reduced interest rates by 50 basis points. And what followed, of course, were these significant crashes in the economy and, of course, the markets as well by over 49 to 50%. So hope you all enjoyed this video, find it helpful. Make sure that you drop a like, subscribe to the channel. I've spent a lot of time kind of researching and putting this data together for all of you. So share this video with your friends and family as well. Other traders, investors that can benefit from the message and the value of this video as well. So I would really appreciate that. Help us get us to our goal of 100,000 subscribers by the end of this year. So this right here is where we are, and the fact that the 50 basis point rate cut is currently in blue, that just means that, if you were to extend those decimal points out, the Fed funds futures is very much pricing in for, a 50 basis point rate reduction going into next week. So next Wednesday, September 18th is when the next FOMC meeting is. And 4.75 and 5% is the rate that the markets are expecting for interest rates to get cut down to. Now, this right here is the Fed funds futures. And this is where we are, of course. We're sitting at 5.33%. This is where we have been since August of 2023. So it's been well over 12 months that we have been at these restrictive policy stance. But I really want to go over to what happened here. And this is back in December 2000s and back in June and July of 2007. So I've got a couple different reports open. So this is from December 19th, 2000. FOMC abandons the fight against inflation, indicates slowing growth is a concern. And if you read a little bit further and what really happened here, so for the first time in 2 years, the Federal Reserve policymakers signaled that recession rather than inflation poses a greater risk to the record U.S. economic expansion, paving a way for a reduction in interest rates as soon as their next meeting at the end of January. So as expected, the Fed's policy-making arm, the Federal Reserve Open Market Committee, FOMC, left the Fed funds target for overnight loans between banks at 6.5%. So that's where interest rates were. They were kept at 6.5% for many, many months, almost as much as 2 years. Fast forward to not January, but April. So this right here was the same sort of timeline. So we're talking now April of 2001. Central banks make another half a point cut in key rates between meetings. And this right here was the progression of those interest rates coming down. So we basically saw from 6.5% back in May of 2000, as I mentioned earlier in that previous report. So this right here was 6.5%. That's where interest rates were, to now getting cut down to 4.5. And that was a progression of 1, 2, 3, 4. 4 50 basis point cuts. In other words, 200 basis points worth of cuts that the Federal Reserve essentially did. And the first one that they did was in January, 50 basis points. So that was the cut from 6.5 down to 6%, then down to 5.5, then down to 5%, then down to 4.5%. So that was 200 basis points worth of cuts between May all the way through April. So that was 1 year of 200 basis points. And the markets right now are pricing in 240 basis points worth of cuts in the next 1 year also, with the first one now shifting more towards 50 basis points. And that's exactly what happened back in January of 2001. January of 2001, that's the timeline that I need you guys to remember. 50 basis points is what the Federal Reserve essentially did. So central banks policymakers cut the target for the federal funds rate another half a percentage point, bringing it down to 4.5% here. And look what happened to the markets in January of 2001. In January of 2001, the markets actually were trading well over 1,400. So that was the S&P 500. So we did see a little bit of a 11% correction. And then what followed over the next couple of years was, of course, a lot of economic pain and suffering. Of course, a crash in the market, over 43% sell-off in the S&P 500. Now let's take a look at what happened in 2007. So this right here was markets soar after the Fed cuts key interest rates by half a point. This is September 18th, 2007. If you read further, the Federal Reserve today lowered its benchmark interest rate by half a point, a forceful policy shift intended to limit the damage to the economy from the recent disorder in the housing and credit markets. And while interest rate cut was widely expected, there had been a profound uncertainty about whether the Fed would choose a more cautious quarter point reduction or half a point reduction. So read this, and it looks very similar to where we are now. Fast forward 14 years, and we are having this discussion whether the Federal Reserve is going to do a 25 or 50 basis points. And now 50 is now becoming a very widely expected rate cut, right? Very similar to what we witnessed back in September of 2007. It's crazy. It's now September 18th is when the next Federal Reserve meeting is. This is wild. This is wild. It's the same timeline that's like literally playing out. Of course, we'll find out very soon what happens with the economy, but the bolder action and the accompanying statement, both approved by a unanimous vote for the central bank's policy setting committee, made it clear that the Federal Reserve has decided that the risks of recession were too big to ignore. Folks, this is literally exactly 14 years ago, September 18th, 2007. And again, Federal Reserve cuts interest rates after keeping them, at higher levels for 4 years. So U.S. stock markets soar after half a percentage point cut for the first time in 4 years. And they soared, and then what happened after, as we already know. So if you come over to essentially September of 2008 here, 2007 actually we're talking, right? So let's just go back. Yep, so September 2007 is the timeline. And this right here is going to be that timeline here. So let's just come back to September. Boom, right here. This was the timeline. So we had the market soaring 11.7% to new all-time highs. That was pretty much the top here as the Federal Reserve cut interest rates by 50 basis points. And then, of course, what followed was just an immense amount of pain and suffering over the next couple of years for the economy, for the markets, dropping over 57%. So it really, in the short term, yes, it's putting like a Band-Aid over a wound, but that wound is going to continue to bleed out if the economy is not doing well, right? If the economy, there's actually underlying weakness in the economy, regardless of what the Federal Reserve ends up doing, if they're too late, if they're too behind the rate cutting sort of cycle, then nothing can really fix the potential unfolding of the economic weakness, and of course the markets to follow as well. So those are some things to keep in mind. 50 basis points, in my opinion, could really just send the markets a wrong message here, considering that we have seen that a couple times already where 50 basis points, yet the markets kind of cheered that in the short term, but it's really just having an understanding of where we are from an economic standpoint, the data points from an economic perspective, whether that's going to hold up or not. Because 50 basis points, every time they've done that on the back of economic weakness. Because if you come over and again read some of these reports, you'll notice they pretty much mentioned to avert a recession. Over here, they mentioned that they are doing it because they want to limit the damage of the economy from the recent disorder in the housing and credit markets. So that is what the markets may read into. Like, why are they doing 50? If they're doing 50, if you go back a couple times, they've done 50. They've done it to avert a recession. They've done it to limit the damage in the economy. They've done it to, make sure that the economy doesn't fall into a recession or there's no hard landing. And that, of course, the markets may be forward-looking and might read too much into it to start rolling over. So some things to keep in mind here, I think that are really, really important. Now, we already know that a fast cycle versus a slow cycle and what the implications might be. S&P 500's performance 6 months before and 12 months after the first Federal Reserve rate cut. And the difference, again, is between a slow cycle and a fast cycle, meaning 25 versus 50. And in a 25, the market seems to be a little bit more calm, more stable, kind of putting their trust in the Federal Reserve to do their job and understanding that, okay, the Federal Reserve does not see any type of a panic in the economy or the markets, and they continue to trend higher and higher as things should be functioning. But a 50 basis points, like I said, can send the markets a wrong message, and that most certainly is going to create this type of environment where why are they doing 50? If they're doing 50, there is a possibility that, okay, economic conditions are not as strong, they're weakening, and something bigger might be on the horizon for the markets and for the economy. So like I said, it really is going to come down to a big debate here between 25 and 50 and how the markets interpret that data point. Now, Tom Lee has some very similar views. So if you come over to this, by the way, before we get into Tom Lee, I want to go over some of the banks and what are they thinking. Even there's this big debate between the banks as well. Even they don't know what the Federal Reserve is going to do. JP Morgan is predicting a 50 basis point rate cut next week. Citi, 25 basis points. Bank of America, 25 basis points. Goldman, 25 basis points. So we got three of the four large banks expecting a 25 basis point cut versus the biggest bank, JP Morgan, expecting 50. And I would actually, revert to JP Morgan because I would assume that Jamie Dimon knows what the Federal Reserve is going to potentially do. Again, not saying that he does, but I would essentially assume that, okay, 50 basis points is the most likely scenario right now, considering that how the odds have shifted. And there's a few very close people, Bill Dudley, and, we've talked about how the senior advisor, economist, very closely working with Jerome Powell, also both of them advocating for a 50 basis point rate cut as well. So when it comes to Tom Lee and his expectations, he essentially said that investors are confused, and that's what the next 8 weeks would look like heading into elections. It's a very challenging period because no one can have any conviction until we know who is in the White House. Some positive supports coming into play with the next week's Fed meeting could give the markets some confidence. And we know that the rate cuts are coming, plus inflation data cooling down, plus labor market needing some support. We do trade well into the meeting, he says, and a week or two after. But he also mentioned that a 25 or 50 has both hawkish and dovish implication. It depends on whether Powell comes across as this is the start of a cycle where they are considering, sort of instilling some confidence in the economy. We are moving back towards neutral. But if it seems like it is dragging along the FOMC members and there is concerns of a hard landing, right? If they actually mention that in their statement that, look, 50 basis points accompanied with a hawkish tone, meaning that we are expecting, economic conditions have weakened or they are deteriorating or they are normalizing, any sort of messaging around that, in my opinion, like I said, is going to send the wrong message to the market of a potential hard landing and that the market can view anything they do as negative, right? That's what Tom Lee also mentioned. And he said that I think it'll be positive overall. From the market's perspective, investors would like the Fed to acknowledge that inflation is moving down and is a secondary concern, and supporting the labor market to avoid a recession is incredibly important. We are losing visibility in the near term, he says. When there is uncertainty, investors sit on their hands. And over the next 12 months, investors should be pretty confident when the Fed has cut interest rates in a soft landing or a no landing. The win ratio 6 months and 12 months out is 100%. But the keywords here are no landing and a soft landing, meaning the U.S. economy avoids a recession. But if we do go into a mild or a semi-severe recession, that's not the case, right? We see the markets come down eventually because it affects earnings as well. And post-elections, markets almost always rally. And the 10 worst first weeks of September. Now, this is a little bit more towards the September seasonality, which I think was very interesting. The 10 worst first weeks of September that we have witnessed, 10 times September first week was down 2.5% or more, September was red. Meaning that we just witnessed the first week of September for the S&P to be down, I think, over 4%. And the probability for us to be green in September is really, really low. So if you come over to the markets right now and you go over to the weekly time frame and see where we are, on the monthly time frame, actually, we are slightly down about 40 basis points. That's how much we are down so far in the month of September for S&P 500. However, 10 out of 10 times we've been red. 20 out of 20 times we have been red in the month of September, when the first week we were down over 2%. So that is very strange seasonality, suggesting for the markets to essentially close down in the month of September. So next 2 to 3 weeks still, there's going to be some volatility, especially when you consider the Federal Reserve meeting and the potential for 50 basis point rate cut as well. So that's where we are. I would really humbly ask everyone to be cautious, be careful here. So, this was also another Twitter post from Elite FX. 25 basis point rate cut. The majority of those expectations are priced in and can see a buy the rumor, sell the news play short term. And a 50 basis point rate cut may cause some FUD, as it shows they are seriously concerned with growth data and cooling signs of the labor market as well, which, like I said, may not be the best case scenario for the markets going forward. So let me know your thoughts down in the comment section below. What are you advocating for, 25 or 50? I would love to see some quantitative easing. It's going to really, help consumers and investors and businesses. Everybody is going to be, better off with lower interest rates. So I think that's important. But at the same time, I'm only concerned with what type of message that sends to the market if they are cutting interest rates starting with 50, as what we have seen back in 2000 and 2007. They were doing that to avoid a recession. So if they're doing 50, are we already in one? Are we expecting one? What kind of messaging could that send to the market? So that's the only thing that I'm concerned about. I do fully want a 50 base point cut because that's going to put people better off in such difficult conditions. But at the same time, that concern is what that message is going to be for the market. So hope you all enjoyed this video. Let me know your thoughts down in the comment section below, and make sure that you drop a like, subscribe to the channel. And as always, happy investing. I'll see you all in the next video.